Good morning, good afternoon, good evening, depending on where you are in the world. At the time when the world is full of uncertainty, we're going to discuss a kind of big picture topic about capital allocation and how the system works, at least in countries with advanced financial systems. And for that, we couldn't think of better speakers than Saule Omarova and Vitor Constancio. Saule Omarova, of course, is the best, and Mark Goldberg, a professor of law at Cornell Law School in Ithaca, New York. She studied at Moscow State University, graduated there in 1989 with Lenin Personal Academic Scholarship, which was a very prestigious thing in the Soviet Union at the time. Moved to the US in 91 and got her PhD at University of Wisconsin-Madison in 1999, and then a Juris Doctor, JD, at Northwestern University, Pritzker School of Law in 2001. Saule Omarova then went into private practice at Davis Polk, then in public policy, 2006-2007 at the US Treasury as a special advisor on domestic finance, and then back to academia as associate professor of law at University of North Carolina in Chapel Hill, and then from 2014 at Cornell, where she is now. As many of you know, she was nominated in September last year as head of the Office of the Comptroller of the Currency. That didn't go through for well-known US political reasons, but that's just testimony to the reputation and policy experience that she has with, of course, countless very influential academic publications. Vitor Constancio studied at the University of Lisbon in economics and at the University of Bristol with a master's degree. He then, early in his career, was at the University of Lisbon as an academic, but then the democratic revolution in Portugal opened new ways, a bit of a parallel story in a way, in 1974. And Vitor Constancio became Secretary of State for Plannings and for Budget and Planning, then went to the Bank of Portugal and back as Minister of Finance in 1978, the youngest ever in Portugal, I think, and then back to the Bank of Portugal, where he was governor from 1985 to 1986. He was then Secretary General of the Socialist Party between 86 and 89, went to the private sector, the Portuguese bank BPI, until 95, and then became a member of the Council of State of Portugal until 1999. Then he has had the highest positions in European central banking, again governor of the Bank of Portugal between 2000 and 2010, and then vice president of the European Central Bank, of course, from 2010 to 2018. Since then, since June 2018, he has also been a professor of banking and financial regulation at the University of Navarra in Spain. With that, Saule, over to you.
Thank you very much, Nicola, for your kind introduction and for inviting me to speak today. So today, I would like to take this opportunity to take a step back and think out loud about why we need to rethink our approach to credit allocation now, and why it is important for us to shift our perspective on the nature of credit allocation as a fundamentally public and not only private activity. I probably won't get through all the slides in my presentation, but that's okay. So right now we're coming out of the pandemic crisis, and just like the previous global crisis in 2008, this forces us to face some hard questions about the relationship between finance and the real economy, states and markets, public and private powers, roles and functions, both in finance and the economy. And how we approach these questions depends to a great extent on how we interpret the crisis that prompted them. So it's well known that the source of the last global financial crisis was the excessive accumulations of leverage and hidden risk in financial markets, and that put a spotlight on issues of financial stability, and particularly shadow banking as the source of a lot of instability in the financial sector. And accordingly, the post-crisis solutions focused on credit modulation, preventing those kinds of accumulations of excessive leverage in the financial system by closing gaps in financial regulation, for example, perhaps restricting future bailouts. Now, the pandemic, of course, is a very different type of a crisis, And it put a spotlight on much deeper and broader structural imbalances in the economy. In the United States in particular, this is, of course, about resiliency of supply chains and inadequacy of public infrastructure, inequality, financial exclusion, and so on and so forth. So that raises a question about what type of post-crisis solutions would be adequate to address those kinds of problems. Should they be more fundamental than what we did last time? So whatever the answers to these questions might be, one thing is clear, that this time around, it cannot be simply about credit modulation. It is going to be about credit allocation. It is about how and where our capital flows in the economy, because that's what determines what kind of economy we get in the end. All too often, however, when we think about credit allocation, we sort of look at it through a particular normative lens, through a set of assumptions that we may not even be aware of. So fundamentally, credit allocation is presumed to be primarily, if not exclusively, a private financial sector activity because of informational advantages that private market participants are presumed to have on the ground, their superior economic incentives, expertise, and so on and so forth. So the public agent's primary function is considered to be credit modulation. Through monetary policy, for example, central banks are managing financial conditions within which then private market participants can make allocative decisions, and through financial regulation. Of course, embedded in that mindset is this preference for discretely targeted piecemeal solutions to specific market failures. In other words, the public agent, the policymakers, are allowed to come into the allocation process only at the point when there is a specific problem, and they come in with a scalpel to kind of excise that particular boil, if you will. Otherwise, they're not necessarily presumed to be actors within that process to the same extent as private market actors are. However, these assumptions do not always hold true. So it's increasingly clear, for instance, that there are systematic deficiencies in private credit allocation on a macro level that perhaps cannot be solved in a piecemeal fashion with a scalpel. For example, for decades, there is a lot of institutional money that has been chasing investment in hard infrastructure assets. And yet, at least in the United States, there are plenty of critical large-scale public infrastructure projects that we all know we need desperately, and yet they do not get financed in private capital markets because of short-term time horizons that private investors have, and because of their unwillingness to kind of tie up their capital in these projects that generate widely dispersed public benefits that can be difficult to privatize. In the wake of the pandemic crisis, it's also increasingly clear that credit allocation is very much a political exercise, and it's politically salient, and it's intensely contested. So monetary fiscal policy nexus, for instance, is now impossible to deny or hide. And that means that we cannot really hide behind technocratic neutrality and these claims of sort of technocratic scalpel type operations solving these allocative problems. And all of this is happening against the larger background of digital technology and digital disruption that is changing how the financial system operates. And one of the interesting things in this respect is that now we can see very clearly that we have a choice with respect to who allocates credit and how they allocate credit. And that choice is not only on an individual level, but it's also on a collective level. Technology is promising that it can eliminate certain publicly inefficient intermediation chains. But at the same time, technology can disrupt or even disable traditional regulatory and monetary policy tools. So if we cannot rely on old assumptions about credit allocation, and we cannot rely on the familiar tools alone of how we manage credit allocation or credit in general, then we need to take a step back and perhaps rethink the very nature of credit allocation as a macro level phenomenon and its implications for the society as a whole. And so here are some very basic, perhaps trivial observations, right? First of all, on a most fundamental level, credit allocation is a distribution of economic resources. These are synonyms, allocation and distribution. Credit allocation also very directly implies and involves practical deployment of capital on the ground. And that in turn determines the compositional structure of the entire economy. In other words, the geographic, composition and the sectoral composition of the nation's economy depends on how credit allocation decisions are made and who makes them. And finally, systematic misallocations of credit are intimately related to overgenerations of credit as well. So, for example, if there are tremendous flows of capital going into, I don't know, speculative trading in mortgage-backed securities, then we know this is a recipe for a systemic financial instability. And that means that getting allocation right is a matter of safeguarding long-term financial stability as well. So what these observations mean is that these are all inherently sort of public spheres of competency. In other words, we can't really rely on informational advantages or incentive advantages of purely private market participants to get, for example, the distributional patterns in the society right from a broader perspective, or to determine the best, most optimal compositional structure of the national economy, or to sort of rely on private market participants alone to safeguard systemic stability. This is simply not what they can do well. And it's not what we should be sort of expecting from them to do well. And what that means is that in order to optimize credit allocation as a societal enterprise, we really need to acknowledge that we need to bring public actors into the process of credit allocation so that their comparative advantages and their incentives and their superior kind of risk-bearing capabilities can supplement, not supplant, but supplement the strength of the private actors in how they allocate credit on the ground. However, public allocation of credit is an extremely difficult enterprise. There are very important challenges there. Getting it right on the public side requires, first of all, qualitative determination of desired macro level outcomes upfront. And that's a highly information intensive process. But most importantly, it is a political process. It requires clear normative priority setting and involves very difficult political trade-offs, extremely visible and highly contestable. It also requires effective tools. And those tools need to be direct, flexible, dynamic. They cannot be blunt. They cannot be indirect. And those tools have to be compatible with and, in effect, mimic the existing financial market modalities. And they have to be able to impact existing market incentives. Otherwise, they will be useless. And finally, public credit allocation requires an institutional platform that has capacity, scale, that is embedded in the existing financial markets, but at the same time is autonomous, both from the private market participants and, very importantly, from the incumbent politicians, while also having mechanisms of democratic accountability. In other words, public allocation of credit is a matter of extremely important institutional design that has to kind of be responsive to financial markets and to politics as well. So basically, I am at the end of my time, and just 1 minute to say that one approach to this institutional design task would be to try to re-envision the central bank's balance sheet as such a platform for better credit allocation, both public and private, because it already functions as a hybrid public-private platform, and very importantly, because the ongoing CBDC debate offers us as a window of opportunity to do it. But the key here is to pursue a cohesive and integrated set of reforms, both on the liability side of the central bank balance sheet and on the asset side. Unfortunately, that's not how the ongoing CBDC debates are structured right now. All of those debates are focused on the liability side of the central bank, leaving the asset side out of it. But if we could integrate the two, then we actually, in my opinion, have a fair shot of solving some of the big policy goals that have been escaping us for decades. And some of these policy goals are listed here. Most important amongst which, in my view, is the productive deployment of credit in the real economy and safeguarding financial stability for the long term. So with that, I will finish my presentation. Thank you.
Thank you very much, Saule. That was great. Clearly some pretty big issues here. As you hinted at the end, you have a few additional slides, which I think are already or will be very soon on the Peterson Institute website as usual. And with that, over to you, Victor.
Yeah, thank you, Nicola, for the invitation. And as a way of introduction to the debate, I will make very briefly 3 points. Well, first, if we look to the title of our webinar, credit allocation. Sorry for that noise. Um, the title of our webinar, Credit Allocation in an Era of Non-Banks and New Technologies. Well, I don't think that non-banks are about to displace the dominant role of banks and capital markets in credit allocation. Well, fintech, P2P, crowdfunding are almost negligible. Credit granting from non-financial firms is also very small. And of course, we have to consider that, say, mutual or investment funds managed by big asset managers are part of the capital markets. They are just intermediaries in the capital markets, although very powerful in allocating capital, but nevertheless, they don't provide an independent source of financing. So it's about banks and capital markets. Insurers are also there a little bit, but the insurance sector is a small part of the whole financial system. So the second point is precisely about the role of banks and capital markets. It's a whole debate, as we all know. But until the big recession of 0809, it was settled in the way of considering that the two financial structures, one more bank-based in Europe, another one much more market-based in the US, more or less performed equally well in promoting growth. And the evidence after the Second World War about the Central European countries compared with the US provides that evidence. Nevertheless, after 0809, there have been emerging new strands of literature. One is about a threshold to the growth of total private credit, loans and bonds, saying or showing that above a certain threshold, more finance is detrimental to growth, starts to have diminishing returns. The other strand is about the highlighting of the particular role of capital markets in what regards promotion of innovation. They seem indeed, by evidence, to be more favorable to finance innovation. And I think that it is linked certainly to the fact that big, deep, liquid stock markets open opportunities to a dynamic venture capital industry that, by organizing IPOs with high returns, offsets the losses that they have in many projects that fail. Well, in Europe and other smaller countries, there have been attempts to follow this model, but they have either failed or they are way too small. That was one of the four reasons why, while in office, I campaigned very much in favor of a capital markets union in Europe, precisely as one of the four reasons for that. But my approach was not conceptually turned to the idea that Europe should converge exactly to the structure of the US, but it would make and should make a bit of the way in that direction. Indeed, because capital markets also have their limitations. There is herd behavior, there is overshooting, there is price misalignment during long periods. And if we look to the US in the past 20 years, there has been negative net issuance of stocks to the tune of $6.8 trillion, which means that the stock exchange is not increasing the financing of the economy, and that's mostly because of the controversial degree of share buybacks. So banks have their own problems, and they are shrinking, but nevertheless, I think that they perform unique functions in the financial system, namely money creation and maturity transformation, in the degree that capital markets cannot ensure, and that's why I consider that nevertheless banks should continue to be a relevant part of our financial systems. And in that perspective, I am against the idea of, say, unbundling banks either by fintech or by central bank digital currencies. My third point is about to what degree should the state try to steer or directly intervene in the composition of economic output and investment, of course, beyond the provision of pure public goods and the correction of market failures that is behind the justification of the sort of welfare state that we enjoy in Europe. So I think that the role of public policies in steering the allocation of resources is increasing and is going to increase, mainly because of the new, very demanding social goals of decarbonization of our economies and increasing their resilience. Well, especially fighting climate change is a big thing, and a field where there are significant externalities, which means that there is a role for public intervention there in different forms. Of course, the investment effort for the challenge of decarbonization will have to come mostly from private firms, but still, for that to happen, in view of the externalities, we also require a significant public intervention in the forms of public investments in infrastructures that crowd in private investment, capital increases in public firms that are directly involved in the greening of the economy, and public subsidies to incentivize private firms to implement the necessary investments. This public effort will not need in Europe new institutions, but requires changes in the Union's fiscal rules for this to happen in terms of public investment, and a desirable repetition of the recent Next Generation EU, but this time focused on environmental objectives and, of course, with a different distribution of the resources. And I finish here.
That's great. Thanks so much. So, in a way, one way I understand, and Vitor, of course, you mentioned that I should have said it in my introduction, you were extremely instrumental in the debate in Europe about Capital Markets Union from the point of view of the ECB and also of the whole financial and fiscal architecture of the Eurozone. So if I get you right, both of you, Vitor, you're advocating something that would be in a way more incremental than what Saule has been talking about, but in terms of consolidating the ability of the European Union to borrow, spend, and tax implicitly, building up on the pretty transformative initial steps that was Next Generation EU in the last 2 years. Whereby Saule, you are advocating something more fundamental in terms of giving the Fed or other central banks in other jurisdictions a more direct role in allocating capital and credit. Do I get that right?
Yeah.
Well, I suppose that's right. I mean, what I'm advocating is basically perhaps widening our intellectual lens a little bit and starting to kind of think about underlying assumptions more. And the proposal about, for example, the central bank taking a greater direct role in credit allocation is only one possibility. In my view, it is sort of one step away from the incremental as we understand it today, but nevertheless still tied to the structures we have.
So obviously, you made the point, Saule, that allocation in this debate can be taken as synonymous with distribution. And so that means basically political power in a very direct sense. And that raises the question of the politics and political control of this expanded function of direct capital allocation by the public sector. How do you think of it? So let's take the Fed assumption, right? I mean, you did just hint at the fact that we could think even more radically. But let's assume there's a new mandate for the Fed. What does that mean in terms of accountability? To put it bluntly, does that mean the Fed is more or less independent than it currently is? That's a question that was raised in the Q&A by Alden Lee.
So this is, of course, the first question that people would ask, right? Whenever anyone says that let's give central bank more power. I think that perhaps that's not the right way to look at it. I mean, ultimately, who is independent in our society, particularly any large public institution or private institution, is not exactly independent, right? It's sort of a question of calibrating the degree of autonomy, and autonomy from which constituencies, under which conditions, and for what purposes. So those are very subtle decisions. So talking about more independent because it does more obviously and more transparently, as opposed to less independent, that's probably not a good way of going about it. So one thing about
it has to be one or the other, right? I mean, it's a very concrete question for people who think about institutional design, or do I get that wrong?
It is a concrete question, but let's think about what's going on now, right, with central bank, particularly the Fed. What's going on right now is the Fed is already allocating credit effectively, right? It just does it through that layer of intermediaries in a particular way, and in every crisis that becomes obvious. So those are political decisions. They just sort of presented as technical decisions because we never admit to their political nature. So the banking sector, for example, right now, I completely agree with Vitor. It's not being displaced necessarily, but it's morphing. And it's been morphing for the last 30, 40 years. It's becoming much more interconnected with markets. And now it's becoming much more interconnected with fintech companies, right? And once it's morphing, the political core of the problem is that the public subsidy that we provide to banks, because they engage in money creation, is becoming very difficult to control. And that's the fundamental issue that sort of we need to confront. Who controls that spread of public subsidy? Should it be Congress or should it be the Fed? So the fear is that, well, if we allow the Fed to participate in credit allocation more directly, then it becomes independent from the populace, from the democratically elected representatives, and makes these decisions on its own. But right now, nobody is making these decisions with respect to how to control the spread of public subsidy. So perhaps the first step toward making it more accountable is admitting what exactly it is doing, and then think about specific mechanisms, how to stop it from allocating willy-nilly. And I think we can do it through design. It's never going to be perfect, though.
Vitor, how do you see the difference in that debate between the Eurozone and the US? I mean, you've been at the heart of the crisis response in the 2010s. And obviously, the Fed was able to use some instruments that were not available to the ECB because of the fragmentation and limited development of bond markets in the EU. Conversely, the ECB did some forms of credit allocation, if one will, with especially sovereign bond buying, which has no equivalent by definition in the US context. So can you tell us about how this debate about the politics of central banking, the politics of central banking decision-making and distributive decision-making resonates with what you have been through during that decade?
Well, I think I will try to broaden my answer to encompass also some of the points that Saul made in a proposal to enlarge enormously and change the role of the central bank. Well, I mention everywhere that's the nature of a proposal. Of course, everything that central banks do has distributional effects. A mere increase or decrease in interest rates does that. So that's unavoidable. The problem is, of course, the definition and the following of a mandate that the central banks receive from political authorities, from the constitution or basic laws. In the case of Europe is the treaty that, of course, defines the objective as primarily price stability, and then other secondary objectives can only come after that. So, and that's, of course, the narrow terms in which the ECB has to operate. And it has operated. I don't think that the central banks should be too much involved in functions of credit allocation per se. And let me highlight that the big increases in the balance sheet of central banks has been implemented overwhelmingly by buying sovereign bonds, treasuries of the respective countries. For instance, in Europe right now, the ECB has a balance sheet almost approaching 7 trillion, but the portfolio of corporate bonds on the asset side of the ECB is only 250 billion. So a small, very small part of the whole balance sheet. So overwhelmingly is other things, which of course are not directly related to choices among sectors or destinations of credit for the economy. It's performing a monetary policy role by intervening in the benchmark of capital markets in every country, which is the sovereign bond market, along the yield curve and along different maturities to bring down the whole yield curve to respond to the recessionary crisis that when central banks use that. More than that, I think it would be totally changing and upending the role of central banks in our economies. Of course, I don't know if Solo also takes their inspiration from MMT. MMT also proposes that, I mean, so-called modern monetary theory, that the central banks should be in a way merged into government apparatus in a more explicit way, that it should ensure low interest rates and monetary financing. Well, it's a concept that I don't subscribe to, this concept, because I think that according to that approach, fiscal policy would have to do everything, both fighting unemployment and fighting inflation, and the lack of flexibility and the political environment of decision making on fiscal policy makes fiscal policy not very efficiently turn to fight inflation, for instance. So that's why central banks exist and have been giving that role, among others. In the US, the mandate is better because it's a dual mandate, which I would prefer also. But in Europe, we have what we have. But to differ from that, I think that would put into question, say, the fundamental organization and role of central banks in our societies. I find that first very difficult to achieve in political economy terms, and second controversial, to say the least.
That's great. We have a good conversation here, and Saule, I will ask you to react. Basically, it's good to think radically, but isn't that too radical? And let me add two side questions about this, which are not entirely peripheral. One is echoing a question that has been asked by Greg Smith in the Q&A. Greg says, is the Chinese model of credit allocation more successful? Because in a way, one underlying question is whether it performs better or worse in terms of speculation and over financialization and volatility of capital. But the broader point is, what kind of precedents would you highlight as guiding the thinking you would like us to have in terms of more radical solutions? Are there any precedents that inform your thinking about this? If so, which ones? And if there are no precedents, doesn't it tell us something about what may or may not be possible? And the other question I have, sorry to pile them up for you, Saule, is what about cross-border interferences here? Because we know that to start with the Fed, but also the ECB are increasingly and very significant extraterritorial impacts of monetary policy. And so how do you think about this enormously enhanced role of a domestic credit allocator, be it the central bank or not, in terms of basically global politics?
Well, these are big questions, right? But I don't know if I agree with the use of term enormous. It's not so much enormous in terms of some kind of quantitative shift, right? It's just a different qualitative direction and different kind of use and different normative goal for what central banks already do right now. To what extent that would affect, for example, the balance sheet quantitatively, it depends on what kind of reforms you choose, right? If you choose one path to go about, for example, it could mean a tremendous growth of the balance sheet, but in other, if you choose some other form of going about it, it may not even involve that. But anyway, precedents. I don't know if there is a one clear precedent for what needs to be done, because if there was one clear precedent, if we could take the Chinese system or some other system and just mimic it, then there would be no need for us to sit here today and talk about these big issues, right? We would just sort of say, follow this route. Yeah. So to me, the main point of my work is to be actually pragmatic, radical and pragmatic at the same time. In other words, radical in way of kind of thinking about how to put together certain elements of what we're already doing or seeing together in a way that would change the outcome. So the inspiration for me is not MMT. I'm not an economist. I'm certainly not. I don't consider myself as belonging to any particular theoretical school in the economics field. But the inspiration for me is maybe generally like the New Deal approach to how you marry the legal and regulatory structure and reform on the one hand with the economic change that you desire on the other hand. In other words, back in 1933, imagine what policymakers were facing. There were no securities laws anywhere in the world. There was no federal deposit insurance or deposit insurance at all existing at that level. Things needed to be invented. And I'm sure there was a lot of debate about how radical you go and how it's going to, destroy innovation and destroy markets and whatnot. But nevertheless, the decision was made because the need was dire. So my inspiration is that at some point we need to understand.
If you allow me to challenge you on this, at the time of the New Deal, there was precedent. There was precedent of basically everything Roosevelt did or wasn't able to do. There were state-level systems of deposit insurance that informed the Federal Deposit Insurance Corporation. There was a Federal Reserve that was expanded and reformed with the Federal Reserve Act. There was, this approach of public investment in the whole history of the U.S. So Roosevelt didn't build from nothing. So my question would be, what kind of, the same way as we can identify prior to the New Deal projects and initiatives that were inspirational for the New Dealers, what would be your inspiration? Some concrete, geographically and historically located projects and initiatives that inspire you?
Well,
other than the New Deal.
It's sort of, there are many elements, right, to the integrated reform on both sides of the central bank's balance sheet. So there are many specific sources of inspiration. And some of them are more salient than others. For example, the Reconstruction Finance Corporation, again, was created before the New Deal, but it was during the New Deal that it was actually used as a tool of public credit allocation. And one can argue with what it's done right, what it's done wrong. But nevertheless, in the United States, since the 50s, while Europe was actually embarking on creating its own institutions of public credit allocation, right, the United States shut down the RFC system. So that is one, for example, answer to what kind of new asset classes we can create by creating new institutional platforms in the United States, new types of asset classes for the central bank, for the Fed, to put on the asset side of its own balance sheet, should it decide to go down the CBDC route in a more kind of assertive and direct way, for instance. A less salient inspiration would be, we have discount window system right now, discount window loans at the Fed, right, at the central bank. But right now they're not used as a tool of sort of the central bank managing credit allocation, really. It's just purely, liquidity provision for otherwise solvent banks. But can we rethink the use of discount window, maybe harking back to even the original history, old history of the central bank, not quite in the same way, but can we reuse it so that the discount window program can become a way for the Fed to channel more of the public funds into the private credit markets, should the Fed go ahead on the liability side and take a more direct approach to CBDC, for example, right? So to me, it's like two sides of the balance sheet. It's kind of hard to say there is one single model, but I think we can pick and choose.
Vitor, reacting to this, but also a question by Kelly Jordan, in your ideal view of capital markets union in Europe, how would it look like? And specifically, as Kelly asks, how would it differ from the US model?
Well, the idea of the capital markets union in Europe is just to overcome the fragmentation into 19 national capital markets, particularly stock exchange, which implies, in my view, an harmonization in a high degree of the stakeholder rights in all countries, so that they would be seemingly equal everywhere, so that any investor would feel at ease by investing in any of the capital markets and the national assets, and also harmonization of taxation of financial products, freedom of movement of dividends and returns, in a seeming way to unify the market, to make it a big unified market. That's not so much then about size initially, but it's about unification with all those very demanding changes that the countries apparently talk about this project, but they are not willing to implement the necessary measures to unify and create a big capital market, which, in my view, and that was another reason starting to become more linked to monetary policy, that the capital market would imply also the creation of a pan-European fixed income instrument, say a pan-European safe asset that would unify and create a capital market for bonds in Europe that would help very much monetary policy whenever is necessary to use QE, and would be a big contribution. There will not be an unified capital markets in Europe without an European safe asset in the end. So all these ideas were behind my campaign, let's say, with many others, to go well beyond what have been so far the projects that have emanated from the EU Commission regarding this project, which, by the way, even those proposals by the Commission have not been fully implemented. So it's really a big miss that in Europe we created a single currency. Countries gave away that important part of their sovereignty, and then we don't take advantage of having a monetary union to create a unified capital markets. It's a big waste. But it's not, as I said, to go in the direction of giving the capital markets such an increase that it would then mimic the overwhelming structure of the U.S. economy for the reasons that I explained. And that's why, for instance, I don't agree with the idea that central bank digital currency would be implemented in a way that would put into question the intermediation role of banks and banks' deposits. So it has to be done in a careful way because that would be, again, upending one of the pieces, shrinking one, but nevertheless, to me, a important piece of the whole financial system. What to finish my answer now? What I find more, say, close to what happens in Europe on the overall proposals by Saul is her idea of creating in the U.S. a national investment agency, more or less under the inspiration of the national of the reconstruction financing finance agency that existed in the New Deal. Well, in Europe, most countries have public financial institutions that can be used to perform a bit that role to support public policies objectives. So it's nothing, say, new in Europe. And that could play perhaps a role when, for the reasons I also indicated, the state is now challenged to do a little more intervention in the allocation of resources in view of the new social challenges with big externalities that we now face. But to completely change the central bank to make it a sort of credit agency of distribution of credit, I don't think would be really adequate for the reasons I mentioned before.
As a history freak, Vitor, I cannot help asking you about the Portuguese experience here, because you've been through all the phases, a corporatist economy under Salazar's, and massive debates in the mid-70s where you were in office about how to shape the new post-revolution financial system. And then, some banks under state direction, Caixa Geral, and privatization, and later on also the intrusion of foreign financial firms. Now, I guess about half of the Portuguese financial system is banking system is foreign banks. The stock exchange is part of Euronext. So there's a lot of foreign cross-border interdependence, primarily within the Eurozone there. So how does that journey inspire your thinking about the different models and how they have performed, and how to think about all this in a way from a Portuguese perspective?
Well, it goes in the direction of what I already mentioned. We do have in Portugal, and we had for many decades, even before the democratic change in '74, we have a big public savings institution along the lines of the French Caisse Générale des Dépôts et Consignations. And we have that, and I think it performs a useful role in the system. Then immediately after the democratic change, which was initially quite radical, there was a nationalization of private banks, but then that was changed in the beginning of the 80s, and the private banks were again privatized. And the system then evolved in the general direction of other European countries. And that has been, I think, a good development along the lines that I mentioned, because from the early stages after the initial radicalism, the objective of Portugal was to be integrated into Europe and then more or less converge to the sort of model and structures that existed in other European countries. And that was the big political aim of the country after that initial more radical stage of democracy.
So Saule, well, you may want to react to all this, but I want also, because we're time flies as usual, bring back the issue of new technology, and especially crypto, There's a question about Alden Lee, will cryptocurrency make banks obsolete? I feel a little bit of a difference in perspective between the two of you. Maybe Vitor downplaying the importance of fintech and crypto and CBDC compared to your approach, Saule, where you see it as one of the avenues for thinking about a better system. So, so if we can move to a little bit of a focus on how these new technologies are changing the debate, Saule.
Okay, thanks. Well, first let me though say that what I'm kind of toying with in my mind, what I'm proposing in effect, right, is not making the Federal Reserve or any central bank an actual credit agency. It's not that at all. The mandate of the Fed is actually, the existing mandate, right, is to maintain the aggregates of credit and money that are commensurate with the productive growth of the economy. I'm paraphrasing, but that is actually the mandate, right? So the problem, however, is whether or not we're actually getting the productivity of the economy, and whether the money and the credit that already are technically available or could be available in that economy actually go into increasing its productivity. And that's the allocation sort of systematic deficiency in leaving credit allocation purely to private market actors that I think is a problem. Not completely displacing it, but fixing that sort of inefficiency, I think, is important. And I think both banks and markets are equally at fault in sort of creating this unproductive use of capital, because we can see how they channel a lot of capital into secondary trading instead of investing it in the economy. So that's that. Now about the technology. Again, I actually agree with you, Vitor, that the banks are not being displaced. They're not going to be obsolete because of fintechs. The problem, however, is that the unbundling of functions that we traditionally associate with banks is happening, and it's happening because of the fintechs. I mean, they can offer now, lending without deposit taking. They can mimic deposit taking without calling them deposits and being regulated as deposit takers effectively, right? So they do that. And moreover, interestingly, at least in the United States, banks themselves are actually very much willing to unbundle those functions, because that opens up for them a lot of new profit making opportunities. And that's what they're trying to do, perhaps not obviously so. So in some sense, I think technology is putting pressure on central banks to deal with the realities that are out there. So we may not like CBDC as an option, but there are stable coins already, and those stable coins are out there, and they're going to be growing. And the stable coins are not just outside of the banking sector, but also, JPM coin, for example, right now.
Yeah, but isn't that a question of the regulatory scope and how it's defined in legislation? So basically, aren't we just seeing a cycle that we've seen before, that there are quasi deposits out there? People think they are safe as deposits, and then it's just a matter of time before the regulators say, okay, they're deposits, and let's regulate them as such, which in a way you could argue is what's happening in China with the whole Alipay saga. So isn't it just a matter of adjusting the scope of regulation, and in that case banking regulation, to the spaces created by new technology, or is it instead something more fundamental? Saule and then Vitor.
I think it is more fundamental than that, because just calling something a deposit itself raises a lot of legal questions and practical questions that, at least in the United States, are very difficult to answer. You call something a deposit, then the next question is, should it be insured by the FDIC, for example? And that is a policy question, and it has tremendous economic and political implications whether or not you decide to insure a particular type of quasi money. And it's also a matter of scope and nature. Money market funds, they always have kind of been substitutes for deposits, but they've never really reached the level of acceptance and circulation as money, as potentially some stable coins might. So to me, regulation itself has limits. Regulatory goals have been defined decades, if not centuries ago, and now in a different market environment, those very goals may need to be rethought.
Vitor?
Well, first let's look to the numbers. The balance sheet of banks has no comparison with the balance sheet of all those fintechs that do some credit here and there. And that's the reality of things up to now. And I think banks have been incorporating themselves a lot of new technologies and will continue to do so on a big scale, on a bigger scale, by the way. Look to the Scandinavian countries and their banks to see that sort of evolution. So that's that about the nimble small fintechs. And that's one aspect of it. Then about regulation. Yes, there are now competitors to bank deposits, but a principle of regulation should be that technology should be neutral in relation to the externalities that have in the past and now justified that why banks are regulated. And the main reason has to do with the protection of deposits, because in the past there were bank failures quite often, and then heavier regulation was introduced to banks precisely because they collect regularly those deposits from the general public with a contract that promise the redemption at nominal terms at par of those deposits. And then they are regulated to ensure that. That's the main reason for banks being regulated. And that's why, for instance, in the US, the presidential group that was created with all the regulators in the US to make a report and a recommendation about the way to treat stable coins came up with the proposal that stable coins liabilities should be treated exactly as bank deposits, and those stable coins entities should then be regulated as banks, perhaps in a slight different way. But that was the recommendation because that's the logic of it. By the way, the stable coins that exist overall are still of the size of a few hundred billion. They are not anything comparable with the sort of the different crypto assets like Bitcoin, which is a different phenomenon that has been made clear that things like Bitcoin with that model cannot become a currency used regularly in retail payments, and it's an asset. It has become an asset competing with other assets, not a currency. So now the problem is the stable coins, particularly if Facebook would go on with its DM project that apparently is going to be dismantled as Libra was. But anyhow, the regulation of stablecoins should be along the lines of that report that the US regulators have published. And finally, about CBDC. I am in favor of central banks creating some sort of central bank digital money, but not in the form of unlimited deposits in the central bank, if that form would be chosen. And the two countries that now have indeed digital central bank digital currency, China and Sweden, that has started recently, have a different model of tokens and not deposits in the central banks, which by themselves signify that the expansion and use of those tokens will be relatively small and destined to substitute notes that are disappearing.
Like digital wallets, basically.
Yes, like they are digital wallets. That's the way they are distributed, and so all these means that regulators have to be careful about that general principle that new technologies by themselves do not make disappear the externalities that led to the regulation of banks. That's a very important principle.
We're nearly at the hour. There are a number of questions. We won't have time to address. There are good questions about inflation from Greg Smith and Asger Torfason. There is a question to you, Vitor, about should we reduce the importance of banks, kind of traditional capital markets union vision from Stefan Schmitz, where you already addressed that in your remarks on how to think about capital markets union, but it would have been good to have more time to debate it. Just one last point, Saule, which I cannot resist asking for conclusion, which is about this question of cross-border impact and thinking of these issues domestically versus internationally. And by the way, of course, there's a big question of digital currencies in less advanced economies and least industrialized countries, which will be probably for a future session. But my question is just, how do you think about it, and especially in terms of cross-border politics, if we have this expanded role for the public sector in credit allocation, there will be cross-border spillovers. Does that create more conflict? How will the world be made more stable with that?
Well, that is a really big question, and I don't have answers yet. I'm still working through a lot of the issues, even with respect to the US and what to do with the Fed's balance sheet, quite frankly. But generally speaking, yes, you are absolutely right. If the public plays greater role, central banks play greater role in credit allocation and money creation on an individual level, then that elevates the significance of those big central banks, at least in the leading markets, right? Kind of coordinating and harmonizing their actions and creating interoperability between their systems. And that is a political exercise. We already know that, different countries can come to a conclusion on anything. Look at what Vitor is telling us about the European Union still cannot even, harmonize its own rules. So that is a tremendous problem. The thing is, though, the impetus for change is really coming from the private sector. The private world, the universe of finance is increasingly global. That's a trivial observation. So we need to kind of start thinking about ways of bringing those central banks and those governments together to the table. Well, I think I will leave it to you, Nicola. I think you are better versed in those international economic relations than I am.
Well, you just said the private sector, the private financial sector is becoming increasingly global. Whether that remains the case, given what we're experiencing this week, of course, is one big question for the future. And we're not going to conclude this one. Actually, I think this session has opened many more questions than it has resolved, but that was in a way what we wanted it to be. The next session will be actually about CBDCs and specifically in the Eurozone context with Ulrich Binzeil, who is very much in charge of that kind of things at the European Central Bank, Vitor's former shop, and Natasha de Terran, who used to work at SWIFT and is very plugged into payments. We will also, I think, have another session for crypto and CBDCs in emerging markets. I just alluded to that. But before concluding, let me again thank very much both our speakers today, Saule Omarova and Vitor Constancio, for what I felt was a very engrossing, thought-provoking conversation about the really big issues about the present and future financial system. Did I say that the next session would be on March 9 at the usual hour of 9 a.m. Eastern US and 3 p.m. Continental European. With that, thanks again and have a great rest of your day.
Yeah. Thank you very much.
Thank you. Bye, Nicola. Bye, Saul.